Thanks for the question. I went about it the indirect way, if you want. Finance in general and investment management in particular was not my first choice. I am an engineer by training, and in fact, my PhD is in engineering. And even though in the back of my mind, I was always fascinated by the world of high finance, you know, there's certain things that I've always known, right? I've known that money makes the world turn around, and I've known that equities, the stock market, is the best way to create wealth, right? Especially multi-generational wealth. So I've always known that, but for different circumstances, including my affinity towards mathematics and sciences, I ended up studying engineering. And I've even taught engineering for a while, and I worked as a consultant. The whole while I was recognizing that while I was fine at whatever it was that I was doing as an engineer, my passion lied someplace else. Now, here I need to be honest, and it was a passion without a lot of knowledge, without, it was not an educated passion, it was imagery and vague ideas, but nevertheless, my love or my attraction to the world of high finance was such that I decided to move away from what I was doing and decided to get a proper education in finance, and then got involved in it. So it was kind of a gradual, and it did involve getting a second education, if you want.
Mm-hmm. So that's very very interesting. And then following up on that, how would you describe your investment strategy, and how did you go about finding that strategy that that best suited you?
I don't know if I found the strategy or the strategy found me, but I recall when I was in business school studying finance, of all the finance courses that I took, the one that spoke the most to me, the one that appealed the most to me was a course on derivatives, right? Where we were taught about forwards, options, and futures. And despite me, you know, loving portfolio theory and all the other, and corporate finance and all the other finance courses that I took, that one was particularly attractive to me because I liked how sophisticated and complex it was. And intuitively, I sensed that this would be the road less traveled, meaning because of the complication and because of the nonlinear relationships that existed between options and the underlying asset, I knew that not everybody was going to be in that. And I thought, you know, that is what I would like to do without any clarity in terms of, okay, well, what about it do you want to do? So I started my career in derivatives, precisely in fixed income derivatives at JP Morgan. And the whole while I was thinking, yeah, okay, this is nice to do fixed income derivatives, to do swaps and swaptions and so forth, but I like the stock market and I like equities, and I would love to be able to combine my love for options and for equity. So while I was still a student, I was so happy, stupidly happy with my own performance in the course that I thought, okay, I'm ready to start trading options. And I remember the very first trade that I did where I put up a decent chunk of money into one trade, ended up losing all the money that I put into it, right? So every penny was gone in no time, because if you know anything about options, you know that they have a very finite life. And if you don't get it right, you know, you lose. And you know, at the time I was discouraged because, wow, how could it be that, you know, I've studied so hard and I did so well in the course, how can I not get it? But you know, typically in life, when you trade using your own money, it's like paying for your second tuition. Now, sure, you could study and you could read books, you could do paper trading, but paper trading doesn't feel the same because you don't have the same emotions when it's not real, right? Sure, you could see how you're doing, but sometimes you take more risks. You don't care as much about losses because they're paper. So it started with that. And while I was a little bit discouraged at the fact that my very first trade went completely bust, I kind of wanted to keep thinking about it. Like, okay, so what went wrong, and how can I fix that? And I went about it the long way. I've probably made every mistake in the book. But at the same time, as I was, making the mistakes and losing money and so forth, I was beginning to form an opinion about, whoa, despite the fact that I'm not doing well, and despite the fact that my performance is very disappointing, I'm finding things about combining options together in a portfolio that we were never taught in school, that are not covered in business books, in finance books, in derivative books. So I started looking into that. How would a portfolio of single stock options perform, right? Not the same as a portfolio of stocks. And so I started delving into that. And then several years ago, I was teaching a course on derivatives, and a bunch of students asked me if one could not start a formal career trading options, can they make money? Can they create wealth by doing it on their own? And specifically, can they do well if they start small? Because obviously there were students and they did not have a lot of money to trade. And when I was asked that question, I did not have the answer. And I said, honestly, I do not know. I don't know if you can, because obviously, options are more complex and they have a lot of leverage in them. So you could easily lose all your money like I did on my first trade. And I decided that the only way I could get the definitive answer to that question is to try it myself. And so I thought, okay, this is going to be a formal track record on what would happen in a portfolio that only trades options. And it's been going on for quite some time, and I'm very happy with the results, and hopefully we'll launch a fund that is based exactly on that strategy and that track record. So it was kind of a process. It was a path that led me to that. It wasn't like a eureka moment.
Absolutely, and I think that's great advice. Try your own. Sometimes make mistakes, and from there you always learn. But from all your experience, what advice will you give to people who are willing to go into investment careers and want to have a future in buy side? What would you tell them to not make the same mistakes?
Okay, well, obviously, buy side is a bit broad. So a buy side could be working for a large hedge mutual fund company, for example. And those tend to be very large and very structured. So if you're patient enough and you want to try to get a job as an analyst, where for the first 2-3 years, say you work at a Vanguard or Fidelity or whatever, and they'll teach you well, and most of them are based on fundamentals. So they teach you how to analyze the financial statements of different companies and come up with valuation models. And so that would be one thing to do. Now, if you are alluding to hedge funds, now this is a bit more complicated for two reasons. A, hedge funds are relatively small. So if you think about the average size of your typical hedge fund, compared to the average size of your typical mutual fund company, they're a lot smaller. They're even smaller than the asset management arm of investment banks. So the buy side within the sell side. Think of Goldman Sachs Asset Management, for example, or JP Morgan Asset Management, right? So because they are small, because they're very, very competitive, and because it has a lot of hot money, they tend to not be very excited about fresh grads from school, right? You've never worked and all you have is your enthusiasm, and you tell them, try me, train me. And the answer is going to be, we don't have the bandwidth to train you. We're relatively small and we're all very busy. We don't have the time to do that. Now, obviously, if you still want to, but it can happen, right? You could still get a job straight out of school, but then you have to stand out. And the question that you have to ask yourself is, as everybody's dream is to skip the sell side completely and start on the buy side, and everybody prefers the alternatives on the buy side over traditional mutual fund companies, so hedge funds, private equity, etc. Right? How do I stand out? And what is going to be my edge as a candidate? So how do I get their attention? And then how is going to be my edge as a professional when I start managing money? Because absent an edge in a space that attracts the smartest, the most sophisticated people on the face of the planet, it will be difficult for you to stand out. So always think of edge. Hedge funds will not be overwhelmingly impressed if all you have to offer is a good education. So if you tell them, I went to UCL and I took, fun courses, and so I would be an excellent candidate, chances are that will not make you stand out, because the people competing against you probably went to excellent schools, maybe UCL, maybe, other schools, and they too have the motivation. So what you have to ask yourself is, well, how do I stand out, right? How do I show them that I have something on the ball? Now, we talked about trading. Obviously, if you show them that you have a very good idea of how things are done in the business beyond what academic textbooks teach you, beyond, oh, I know how to value a company, or I know how to price a bond, right? If you show them how you do that, and you show them that your passion and perseverance, for example, has led you to start, I don't know, a trading club or a trading account where preferably with real money. So, you put up a small amount of money and you decided to put it at risk, knowing that you could lose, and this is how much you want that. That would be a lot more convincing than just putting a list of courses that you took in college. It's all about standing out. It's all about capturing the attention and the imagination of a decision maker who usually doesn't have a lot of time to read through pages and pages of CVs. So very competitive. And it takes patience.
Absolutely. Yeah, and that's some great points. So now going on to Namur Capital Management. What was the main rationale behind starting your own asset management firm, and how did that go about?
Well, I think the idea was kind of dormant in my head as I was moving from one corporate job to the other. And at the time, I was a general manager at Shell Trading, which is an energy trading and marketing company owned by Royal Dutch Shell. And I was thinking, wow, all the trading strategies that we follow, managing not only physical energy, which obviously we did, but also energy derivatives. Think of natural gas, think of oil, think of propane, gasoline, even electricity. And I thought, you know what? How about if one can have all that quote unquote fun without being tethered to a big corporate structure? So, and that was happening at a time when I was getting a lot of questions from people about, investment advice. Hey, my private banker has shown me this investment. Do you mind taking a look at it and tell me if I should do it or not? Or, here's my portfolio with this particular broker. Can you tell me if I'm doing okay or not? So I was having the ideas of managing money, but at the same time, I was getting these requests for what will end up being the wealth advisory part of my business. And I don't know if the audience knows the difference between management and advisory. Management is you actually manage somebody's money. And in a wealth management situation, it's typically separately managed account. So everybody's account is separate. It's not in a fund. Advisory is not about managing money. It's about giving advice. So typically the client would have their money with another institution. In my case, it was mostly private banks. And private banks, being who they are and what they are, oftentimes their clients would be suspicious of, why are they selling me this, or how did they structure that portfolio, or I'm not very sophisticated, but it doesn't look right. So they would come to you, and you would still not be managing their money, but you would give them the proper advice about individual products, individual funds that they want to put them into, and how the portfolio is doing on a risk-adjusted basis. So that's how it started. I was getting requests, and I thought, okay, rather than just dispensing free advice left and right, why not have the same fun and make a living out of it? So that's kind of the genesis. Being tired of the corporate world and the bureaucracy, and at the same time, being approached by a lot of people to help with different mandates.
Absolutely, and it definitely sounds really exciting. So, looking back at that time as well, what were maybe some of your investment ideas, strategies that went really well, and some that totally failed? And what did you learn from either?
Okay, Laura, let me tell you off the bat, you never learn from something that works for you, right? If things work, great, you made money, good for you. You don't learn from that. There's no learning from, right? The only tuition money, the only thing that will be ingrained in your mind and that you'll never forget is from your losses, from your mistakes, right? So what worked for me? Lots of things. What did I learn from them? Other than a higher conviction level that my strategy, my approach to managing money works, not a lot. What I've learned from my mistakes is in fact fundamental to my strategy. I remember early on, before I started my firm, hearing, I think somebody on television or maybe in a lecture, I don't remember, but somebody said, most options expire worthless. Right? So that means that if you're in the business of buying options all the time, you would lose all your money in more cases than not. Right? That's what it meant. Now, those who take options courses with me know that, in fact, the statement itself is wrong, right? Because by definition, if a call option expires worthless, the equivalent put option is in the money. But never mind that. That's what I heard. And it prompted an idea in my head that, okay, so if you are in the business of always buying options, you would lose in the long run. So the opposite must be true, meaning if you're in the business of always selling options, to use the technical term, writing options, you'll make money. So for a while, I thought, okay, well, this is a lovely way to start printing money. So I started writing options. And at a time when the market was trending, for the record, I was writing put options. So while the market was trending, it was working beautifully, right? You sell something for I don't know, for $10, and then it falls to 2, and then you cover that. You buy it back at 2, and then you sell another one at 10, and then you cover. So you just keep on making a little bit of money as you go. And I'm like, whoa, okay, I found the holy grail. And then there was an event in the market that got the stocks that I was doing this based on, so the puts obviously had an underlying, right, completely collapsed, right? So all at once, all the puts that I was selling, all the insurance that I was selling came due. And that cost me, so at first I was in disbelief, how could something that has worked so well for so long fail me now? Right, but then the losses went from small to medium, from medium to large, from large to catastrophic. Before I got my wake up call and said, "Whoa, this is really bad." And in fact, you saw the same thing happen during the great financial crisis of 2008, where companies, insurance companies like AIG Financial Products, which is a subsidiary of AIG, was in the business of selling credit default swaps. Credit default swaps, it's also like an insurance against bonds defaulting. So it's the same thing that I tried. And for a while, it was working great for them because the housing market was doing well, mortgages were doing well. So they were collecting insurance premium and nothing bad happened. And then all at once, the housing market crashed, the mortgage-backed securities blew up, and then all the insurance policies, so to speak, that they sold came due. Now there are big claims, and they did not have the money to pay the claims, so they went belly up, and they had to be rescued by the government. So it was a lesson that I will never forget, and I will never again act as an insurance company for anyone. Right, writing insurance just for the sake of collecting premium, huge mistake. I will never make that mistake again. So it's the point that you tried to make. Good ideas and bad ideas. Good ideas are good, and you're kind of happy with yourself, and you pat yourself on the back, say, hey, it worked. But it won't make you a better investor. It won't make you a better trader, right? What makes you a better trader is mistakes, is losses. Those stay with you, and you'll never forget the stuff that caused you a lot of pain. You'll forget the things that just came and went and nothing happened. So all this to say that we collectively, all of us, should be accepting of the fact that we will make mistakes. Not we may make mistakes, we will make mistakes. And if you want to be in this business, you should reconcile yourself with the idea of losses, right? Losses are part of the game. They're not the exception, right? Even the most legendary investors or traders oftentimes don't have a batting average more than 0.5, right? Meaning not a lot more than half their trades are successful. But the way they make money is to make sure that the successful trades make them a lot more money than what they lose on the losing trade. So this is the game. The game is not, I don't want to ever have a losing trade. That's impossible. And if you can't accept losses and you can't take them, it'll be difficult for you to adapt to this business.
Absolutely. So now looking at the markets right now, just yesterday marked the 1-year anniversary of the market pattern following the pandemic-induced recession and bear market in stocks. So what is your take on markets right now? And are there any sector or risk factors that you favor over others?
Okay, so 2 questions. How do I feel about the market right now, 1 year or 1 year plus 1 day after the big market bottom of March 26 or 23rd, excuse me. And the second question is, which sectors do I favor? Okay. Well, the biggest lesson of what happened, let's say in 2020, is the extent to which the economy can be dissociated from the stock market. So clearly the global economy was not doing well for the most part in 2020, and yet the stock market, since it hit the bottom on March 23rd, basically zoomed up and did exceedingly well. So now we are in the second year of a brand new bull market. So we had a bear market. It was super condensed. It happened very, very quickly because of the, as you said, because of the pandemic. And then we were at the dawn of a new bull market, and now we are, in year 2 of a bull market. So whereas last year, almost anything you touched would have turned into gold, right? Everything was rising, especially work from home stocks, right? Things that benefited from people staying at home, or technology, or high growth companies. And the ones that got penalized the most are what I would call the epicenter stocks. So epicenter stocks are stocks in businesses that are at the core of the crisis. So think, airlines, think hospitality, hotels, restaurant chains, casinos, cruise lines, etc. Historically, year 2 of a bull market is a bit more delicate than year 1. So year 1, everything rises. All you need is exposure to the market to make money. Year 2, you need to be a lot more discerning, right? Why? Because the first thing that is happening right now, and you asked me about my take on the market, so I thought I would give you my take on the markets. So not just the stock market, but everything. So obviously the last several weeks have seen a huge decline in treasury bond prices, leading to a big spike in treasury yields. So now we could debate, why is it that treasury yields are up as much as they are, as quickly as they have risen? Now, I think there's a good reason and a bad reason. So one reason will be good for risky assets like the stock market, and one reason would not be so good. So the good reason would be, well, because the global economy is reopening, and there's a lot of pent-up demand, and we expect a huge recovery in everything that is cyclical, right? So the price of money will have to go up because there's more competition for capital. That would be a good thing, right? That would be interest rates rising for the good reason. A bad reason, or an unattractive reason, would be because inflation is beginning to build itself up into the system. And that's usually not a very good thing. Now, if you ask me my opinion, I think it's a combination of both. Obviously, inflationary pressure is building a little bit, but from very, very, very low inflation levels, right? So, from the financial crisis till now, despite all the money that was pumped into the system, that did not lead to inflation until now. And there's a very good chance that inflation is now, whether it's transitory, meaning, we'll have heightened inflation for a few months and then, we go back to trend or below trend, or whether it's a little bit more sticky, it's too soon to determine. So because of that, and because interest rates are higher, the sectors that will do better are, first of all, the sectors that are leveraged to the economy, right? So whereas, for example, in 2020, the stocks that did the best were stocks that are known as secular growers, meaning they are always growing in good times and bad. So whether we are in an up cycle or a down cycle in the economy, they're always doing well, right? Typically, we're talking about technology companies, right? They're always growing. right? So in a year like 2020, when there was no growth anywhere else, people were willing to pay up a lot of money for these stocks. And that's why they were bid up the way they did. And that's why they performed as well as they did. For 2021, now that the market is coming back, and excuse me, the economy is coming back and there is growth. Now, all at once, people are saying, okay, why should I, pay a P of 75 for this secular grower if I can pay 20 for this not secular grower, but it will grow now that the economy is expanding the way it is. So you will see, value companies perform better than high growth companies because of that. And another reason for that is because a lot of technology companies, the way they are valued relies a lot on the money that they will make in the future, right? So now that interest rates are rising, people will discount those at a higher rate than they did last year when interest rates were basically at zero. So I think, sectors like financials, which will benefit from a steep yield curve. I think airlines, industrial companies, casinos, hotels, restaurants, materials, right? So in terms of commodities, commodity prices will go up. Think of copper, think of lumber. So I think those will do quite well. Technology companies, I think some of them will do well. Some of them not quite as well. But 2021 will show an expansion in the breadth of the bull market. So the number of stocks rising is going to expand, already is, but it will do further relative to 2020. So those will be kind of what I favor right now.
And now looking also at new investment ideas that are gaining traction recently, such as cryptocurrencies or ESG investing. Do you think that those are also suitable options for hedge funds wishing not to be left behind?
That's a difficult question to answer because let's talk about ESG, for example. And let's say you are a traditional fund and you're thinking about broadening and let's say you're a long short fund, right? And you're thinking about broadening your appeal by committing to ESG. So do you only commit to ESG on the long side, but you'd have no problem shorting companies that score low on your favorite ESG scale? That's number one. Number two, if you start going with that argument, right? I want to buy companies that score well on an ESG scale. Well, then what would differentiate you from a long-only fund, so let's say a mutual fund, for example, or even an active ETF, that is doing the same, right? The shorting parts in the long short will create a complication when it comes to ESGs. Now, I'm not saying that people cannot do that. Whether that will be the salvation from following years of underperformance and years of disappointing returns, let's say, from 2015 till last year, I don't know. Crypto is a bit more complicated. Crypto, first of all, we need to decide what is crypto. Now, is it a currency? You're probably tempted to say, duh, of course it's a currency. It's called cryptocurrency. But currency for me is not something that has a gigantic volatility that could rise from 3,000 to 60,000 in less than a year. And currency is something that you're willing to use in exchange for services and goods. I'm thinking about the people who 5-10 years ago, at the very early days of, let's say, Bitcoin, were happy to pay for their pizza delivery, paying 2 Bitcoins, for example, right? So back when Bitcoin was at $5 or whatever, they would pay 2 Bitcoins for the pizza. Imagine how they feel now in hindsight that they spent $120,000 to get 2 pizzas. So the question is, are people who are attracted by all cryptos, Bitcoin and all the rest, do they really think of this as a way to pay for services and goods? Or do they think of it as a way to speculate, right? I mean, now that I've noticed that Bitcoin went from 3,000 to 60,000 in less than 12 months, what if it repeats the same performance so I can make more and more money? So that is one thing we have to decide. So is it a currency, is it a store of value, or is it an inflation hedge? That's number one. Number two, so to the people who argue, no, it's a currency, and the evidence that I have for that is look at companies like MicroStrategy, for example, that puts all their cash on their balance sheet. In fact, more than the cash they have, they borrowed to top up the cash that they have, and they put it all in cryptocurrencies. Look at Tesla, who's invested $1.5 billion in cryptos, and they announced this morning that they will accept Bitcoin as payment for their cars, and the proceeds from the sales will not be converted into fiat currency. So this is where it becomes dicey. So if you're a hedge fund and you want to capitalize on this appetite, this excitement about Bitcoins, what are you going to do? If all you're going to do is every time somebody gives you money, so your limited partners, your investors give you money, you automatically go and use that money to buy either one crypto or a basket of cryptos, well, where's your value added really? Because those people could have done exactly the same thing with their money. So why would you earn 2% management fees and 20% performance fees if all you know how to do is receive the money and buy it on the market? What else can you do? Well, you could try to trade it smartly. So look at charts, and when it gets extended, kind of trim some. And so the way you want to create value is by being a technical trader. Okay, perhaps. I'm a bit skeptical about that because nowadays, increasingly, even retail investors are becoming good at this. So, they add a little bit when things retrace, and then they sell some or they trim some on the way up. So I would say if you're a hedge fund and you're struggling and people are leaving you, right? Your clients are redeeming, and your idea of salvation is just to use the word crypto someplace in your prospectus, in your market pitch, I would say it's probably not going to work. But I see blockchain technology playing a huge part. So blockchain, apart from cryptos, playing a huge part in the buy side industry, including tracking who has invested and where, using blockchain, not using a central repository. So that's what I think about that.
Absolutely. And now my last question from our side before going into Q&A with the audience. Also, considering the ever-changing landscape of the markets and now having discussed some of the new trends, do you think that traditional strategies such as long-short equity or dedicated short bias will still exist in the next 10 to 30 years?
So you're asking me, will hedge fund 1.0 survive into hedge fund 2.0? I would say some might. The first question you have to ask yourself is, historically, how did hedge funds want to make money and how did they make money? And then what has stopped working over the last few years? So why is it that years and years of good performance and satisfying their mandate seems to not work anymore? So first of all, if you're a hedge fund, what are you telling your limited partners, your investors? Are you telling them that you are going to beat a specific index every year? No, right? You call yourself absolute performance, meaning you don't want to be viewed as a relative performer, as you're trying to outperform a benchmark. So your argument, right, your pitch to your LPs is, I will make you money in good markets or bad. Now, presumably implied in this statement that in bad markets, I will do a lot better than the general market, because the general market is likely to be down, and I will be up. And then maybe in a very strong up market, maybe I will underperform because I not only have longs, but I have shorts. Okay. And the second pitch, the second argument that you make to your investors is you tell them, I'm going to give you a product, this investment, that is not highly correlated with the traditional assets or the asset classes that you're likely to be invested in, right? So, most big investors are already invested in equities, they're invested in bonds. So you tell them, well, I'm going to give you something that is not correlated to that. And the last thing you try to tell them is, and my performance is not going to be very volatile, right? Not huge ups and huge downs. Now, on the one promise that seemed to have stopped working lately is, I will make you money good times and bad. And of late, there's been a rebellion on the part of large institutional investors, but also high net worth individuals against the hedge funds. And the argument is that, the market is up 15%. You're up 3%. And yet you want me to pay you 2% management fees every year, and then 20% of that measly 3% that you made me. This is unbearable. I don't like this. I'm walking. Right? So a lot of hedge funds have suffered significant redemptions. A lot of them have closed down. And so you ask yourself, well, where did that money go? A lot of it went to private equity. Now, we could debate whether the advocated, the announced performance of private equities is a true reflection of how that industry is doing, right? But nevertheless, it looks good. Let's go there. So increasingly, people are wondering, why are we not doing well? Well, you're not doing well because if you're a large fund, right, all the funds are going to end up investing in the same names. If I manage $10 billion fund, I'm not going to invest in a stock that has a market cap of 1 billion. It makes no sense. You won't show in my performance. So all these big ones are going to end up trading the same very, very large cap stocks. Pick another strategy, risk arbitrage, which is about trying to make money following an M&A announcement, the merger and acquisition announcement. Well, all the funds are going to be trading the same M&A announcements because those are the ones that were announced. I cannot go and make up something that didn't happen. Same thing with convertible bond arbitrage, where you need to find a convertible bond so that you could build a trade on it. So if all of us, let's say the big ones, are looking at the same things and are trading the same things, how can we all outperform in a zero-sum game? It makes no sense. It cannot, mathematically, it cannot happen. Now, that is why, for example, emerging managers, so very small funds, tend to do a lot better, regardless of the strategy, than the very big ones. And the big ones are having to scratch their heads and say, okay, so what should we do now? What is it that we should consider? A lot of them have thought, okay, maybe the salvation is in the form of using artificial intelligence. AI is increasingly being used. Others are saying, well, okay, let's change the way we look at things. So I would say everybody is going to be forced to rethink because the old players, if they don't reform their ways, if they don't come up with a new source of alpha, as it's called in the business, then they're going to fall by the wayside. And those who come with new ideas and new ways of doing things and new sources of performance, I think will prosper. So will they still exist 10 to 30 years from now? Some may, but I suspect when we look at the list of strategies, there will be ones that we're not talking about today. They haven't happened yet.
Thank you so much for the great answer. Now we'll be taking questions from the audience. So Jonathan, if you'd like to take over.
Yeah, thank you, Dr. Nemour, for providing wonderful insights that are all very helpful for the attendants. So due to the time pressure, I suppose each of the attendants will require to ask only one question. So it will be great. So everyone can take the chance. So Artur Sakovic, you can start your question.
Hello, thank you very much for your talk. It was very informing. And my question is, do you think that with development of high frequency trading, it will eradicate most of the market inefficiencies? And if it happens so, what's the future of traders? Will this technology replace traders, or at least a big chunk of them?
No, I don't think it will replace them. I mean, obviously, in my opinion, high frequency trading has a relatively limited shelf life, right? So for those who don't know, high frequency trading is using unbelievably fast connection speed so that you could see an order come in, and before it arrives, you get there in front of it, and you collect tiny bits and pieces of profit. But you do it so many times during the day that you end up making a lot of money. And in general, because it's not a directional bet on the market, typically you're always making money. Now, obviously, this is a rather expensive proposition. It has requirements. You need to be very, very, very close to the exchange. And then ultimately, as more and more people develop the speed that would allow them to compete, like everything, the more entrants you have, the lower the profits, and it would get to where it's not necessarily efficient. And in fact, most hedge funds do not focus on HFT. There are special trading shops that do nothing but HFT. And to maximize their speed, they are typically located right next to the exchange. So no, I don't think it will end trading.
Yeah, so next attendant, Tristan Lascott, you can ask your question now.
Hi, thanks for the talk. It's been really insightful. My question is, there are some detractors of the Bayesian models, you know, the traditional options pricing models. There's some detractors that say that they don't account for tail risk well. So what are your views on that? And have you, over your career, have you seen any new developments in how models try to account for that? Thanks.
Thanks. Very, very interesting question, especially for an options trader. Yes, I believe there is persistence in market prices of options not reflecting the fatness of tails properly, right? So you know, the typical options models do not necessarily reflect that. And that is why, in general, out-of-the-money options are relatively cheap. Now, what would you do with that is another question. So just because out-of-the-money options are cheap, should I build a strategy based on always buying deep out-of-the-money options? The answer is no, because your investors will not tolerate the way that strategy would perform. That strategy would bleed money most of the time, right? Because most of these options, cheap or not cheap, will expire worthless because they're so deep out of the money. But every now and then you get a huge payoff, right? So you know, let's say you're long a bunch of put options on a specific stock or on the stock market, and the market crashes. So the value of these options would multiply by 1,000, right? It can happen. I've seen it happen. And that would make for a lovely, lovely payday. The question is, can you do it as an ongoing strategy as opposed to doing it occasionally when you think a big event is coming? And my answer is no, and it's been tried, by the way. People have tried doing that. Other people have tried maintaining their normal exposure, right? So rather than allocate 100% to my strategy, I can allocate 95% and then use 5% all the time buying risk, right? By buying the fatness of the tails, which would be deep out of the money stuff, knowing that in most months, that 5% is going to go to zero. But luckily, I still have the other 95%. And then when, let's say, a crash happens, then that 5% will compensate for the losses in the 95%. So yeah, it's the evidence is that tails are fatter than is typically modeled.
Yeah, thank you for your wonderful insights. So Zain Mohammed, you can ask your question now.
Hi, Dr. Nemour. It's Zen here. I'm a first-year analyst at Lazard, and I'm in the natural resources team in London. I work with Spiro Joachim. It seems like perhaps you know him.
A friend of mine.
Yeah,
absolutely.
Just perhaps your Lebanese link. I'm assuming. But yeah, my question. Thank you for the very eloquent talk, and I'd like to say that I like your style of delivery. It's very clear. It was very informative, and I learned a lot within this short period of time. So thank you very much for that. My question is about volatility. So I had a chemistry teacher who used to work in JP Morgan for 14 years as an options trader. And we invited him round to our investment society in Cambridge a couple of years ago. And one thing that he said is that, after sort of 2008, 2009, the subsequent years after that, volatility really did, take a hit. And, there wasn't as much volatility. So there was less opportunities for options traders to profit off the market. Has recently, obviously, because of the pandemic, I imagine volatility has now, spiked up a little bit more. How do you see that affecting your business? That would be quite interesting to know.
Yes, true that following the crisis, especially following, let's say 2011. So from 2011 till the top of the market last year in February of 2020, volatility was chronically low. Now, it doesn't mean that it stopped behaving the way it does with the normal spikes. But for example, I had always believed that the VIX index, which captures the implied volatility of the S&P, would bottom typically in the low teens, 12, 13, right? So that would be a good time to buy protection. And yet we saw protracted instances where the VIX index went into the single digit. I had never seen that before. I didn't think it was possible, and yet it happened. Now, conversely, look at what has happened since the bottom a year ago. Sure, the VIX has spiked the way you'd have expected it to, not only in March, but also during the correction in September, and then again in November. But then when it falls till a couple of days ago, the VIX would not break 20. And 20 for a market that is doing very well, that is rising, is high. It's a heightened volatility. And that's why a lot of people who trade, some traders don't just trade options, they trade what is known as the volatility surface. And obviously they're not only interested in the volatility, right, the VIX, but they're also interested in the volatility of the volatility, right? So we've had a spike in that. And like I said, till recently, because a couple of days ago, it finally broke 20. Now, how did it affect me? Well, it was great when it was very, very low, because I'm always a buyer of risk. I'm not a seller of risk. And I like it when risk is cheap. So when implied vols are low, then the options that I buy are low. And if implied is always lower than the realized volatility, then that's a very good thing. So, but yeah, you're right, it affects you. And conversely, last year, early this year, the options were more expensive than normal. And sometimes they would rise. So it hurts in that you pay more for risk, but it sometimes helps you when the underlying moves against you, but the move is offset by a rise in volatility, right? So it lessens the losses. Very good question, very insightful.
Thank you very much for that. Thank you.
Yeah, so Maximilian, you can ask your question now.
Okay, thank you for the opportunity to ask the question. And my question is, what is your outlook on emerging markets? Will they catch up with the emerged ones in the few years, or suffer from instability or slow vaccine rollout, especially in the next 2 years?
Well, in general, because there's going to be a rise in risk appetites, and obviously emerging markets are riskier than developed markets, I think emerging markets will do quite well. But just like I think the whole stock market would rise, but let's say value stocks would perform better than growth stocks, or cyclical stocks would perform better than growth stocks, I think non-China stocks will do better than China stocks. Why? Because Chinese stocks in 2020 acted as a safe haven. So people like to hide in them because they were doing so well. And you know, think of stocks like NetEase and Baidu and Pinduoduo and all those, JD, etc. They did very, very well. Right, so because they were perceived as safe for a lot of reasons, including how quickly China came out of the pandemic. Well, now that they've become kind of expensive and a lot of emerging markets are kind of cheap, people may rotate away from China into other traditional emerging markets. Think of Latin America, think of India, etc. But yeah, I think emerging markets will do quite well. The caveat that I have is emerging markets that are very dependent on oil imports. If oil prices rise too fast, too much, right? That would complicate things a little bit. But yes, bullish on EM.
Okay, so I think due to time pressure, there is one last question. Ali, you can ask your question now.
Thank you for the opportunity. My question for Dr. Nemour is, do you follow specific trading rules for taking profits or stopping losses? And do you ever deviate from those rules? Thank you.
Let me tell you that in general, without talking about the rules relating to taking profits or stopping losses, usually when I deviate from my rules, it does not end very well. I mean, I'm giving you an example. When I get excited about a piece of news and I decide to act on it. So think about, I don't know, a vaccine announcement. And I say, whoa, this is great. This is a game changer. So I, you know, even though it does not fit into my criteria. So let's say I go and buy, you know, a stock of I don't know, Pfizer or J&J or Moderna, whatever it is. Every time it ended up being at least disappointing, right? And that's what happens when you don't stick to your discipline. Now, stop losses when you trade options is a bit complicated, meaning if you enter them, because the bid and the ask tend to be wide. And because when the market makers see where you are, they may kind of push their market a little bit to trigger your stop loss before moving back. So I think in my case, I don't enter them in a hard way, right? They're not coded in the system, but every now and then I say, okay, I was in that stock because I had that view, that view has changed, so I need to close it, but I would typically close it manually. On taking profits, because I use options, there are different ways of taking profit. So there are ways, for example, to roll your position up and out, meaning, raise the strike and increase the maturity and still extract cash, right? Sell 10 contracts at a lower strike, buy 10 contracts at a higher strike to replace them. Since what you're buying is cheaper than what you're selling, then you would have extracted cash and yet keep your exposure. So if you do it enough times on the same stock, it won't take you long before you end up playing with the house money. And so you tend to not want to take any action, kind of let it run and see where it goes. Very good question. Thank you.
So Dr. Nemour, do you have time for one last question? I saw there is a hands up by Sammy.
Sure.
Yeah, thank you so much. So Sammy, you can ask your question now.
Yes, hi, Dr. Nemour. I have one question on my side, and it's an interesting topic that I don't think was brought up during this call. So we saw that 2020 was a record year for SPACs, and especially capital that was raised through SPACs. Now, anecdotally, to the point where celebrities started putting their faces behind SPACs. So for those who don't know, in its most simple form, investing in SPACs is essentially writing a blank check behind a sponsor. So, and it's something that you would rationally do in the absence of other positive NPV opportunities. Now, looking at the performance of markets in hindsight in 2020, what does that really say about capital allocation in the market nowadays?
Very good question about SPACs, and very apt name to call them a blank check, because that's essentially what you're doing. When you invest in a SPAC and you don't know, all you know is an acquisition vehicle, but you don't know what is going to be acquired. You don't know at what price. We saw the debacle with Churchill 4 and Lucid, the EV company. It's very, very risky. And the reason we saw a flurry of money chasing that is, first and foremost, I don't want to call it rational or not rational, but first and foremost, a reaction of all the liquidity that existed in the system, right? So think of all the government checks that people receive, think of all the money printed by all the central banks, think of all the money slushing around. Now, in principle, the closer you are to your bottom price on a SPAC of $10, the less risk you're taking. And then you could view that as a call option, right? Upside, if I buy it at 10, the worst thing that can happen is I get my 10 back. What am I risking? If the acquisition is great and it appreciates, I make money. If not, then I don't. Where it becomes problematic is when momentum starts pushing up a SPAC farther and farther from 10, right? And you still don't know what is going on. It's fueled by rumors. Oh, I understand they're talking to so-and-so because they want to buy it out that way. So I think this is very risky. And I don't know if everybody who played the SPAC game fully understood the risk that they're taking. But since I mentioned a lot of optionality, in fairness to SPACs, they have optionality in them, but that's only conditional on you buying it rather low, right? The more you pay up, the more expectations you're building in, the more likely you are to be disappointed, no matter what the acquisition is. So I think SPACs as a vehicle, as a way of doing acquisitions, as a way of taking companies public, is here to stay. And by the way, it did not start in 2020. It just, the fervor peaked in 2020 and may be coming back. So in my opinion, it's a good idea, but like everything, I mean, sometimes you take it to irrational levels. We can ask ourselves the question, is GameStop worth $150? I mean, people are willing to pay them, diamond hands and all that. So I don't know. I think it's a cool thing, but when you have too much money chasing it, it turns a good thing into potential losses, potentially big losses. So as always, investors beware. Know what you're buying and know why you're buying it. Same thing, by the way, if you play the SPACs using the warrants, because typically they all have warrants, and typically the strike of a warrant is 11.5, so a bit higher than 10. I know people who have done arbitrage using SPAC warrants, right? You could, and the market for warrants, which is different kind of options, is inefficient enough that you could still find arbitrage in warrants. Very good question on SPACs. Very apropos. Thank you.
I think this concludes all the questions. So thank you very much, Dr. Nemour, for taking the time answering all these Q&As and have the support for us to hold this Hedge Fund 2.0 event. So thank you very much for everyone who has attended this event. And see you guys next time in our future events at UCO Hedge Fund Society.
Thank you, Jonathan. Thank you for the invite.
Thank you so much.